Hello, ladies and gentlemen. It's a financial show, Modern Investing with Sasha. My name is Sasha Star, and I would like to introduce my esteemed guest, my co-host, Peter Bennett. Welcome to the show,
Hey,
former Wall Street professional, and Nick Palivedo, founder of the network. Welcome, Nick, to the show.
Hi, Sasha. How are you doing?
Good, good. There was a lot of turbulence on the markets lately. I think that the significant damage was done. A lot of investors were separated from their money, and now
sure.
uh, through combination of stop losses selling, margin accounts selling, or so on, probably the worst is done, at least for now. I think that because stocks are doing in the direction of the least resistance. So right now, especially talking about high-tech giant stocks, there's very little, if any, resistance left for them to go somewhat higher. And that's hopefully what will happen in the near future, as in a while, high yield dividend stocks are performing spectacularly well in this environment. They're either somewhat higher than they were a week ago, most of them for sure. And right now, the market is at the crossroads. What's next? Today is pretty good day so far. I'm not sure that it will close as high as it is now, but we'll see. And maybe there is a because of the Good Friday, maybe there is another update tomorrow. We'll see about that. What, Peter? What do you think?
Well, I mean, the same story for months and months. I was talking about it for even longer, but now, I mean, it's all about Fed and inflation and energy. And, the question is, how bad will inflation be and how much the Fed has to control it? So, first of all, the numbers are really bad. The recent 8.5% consumer price index year over year, today, 11.2% producer price index. And that has to get passed to consumers. So this is like the 80s. They're saying it's the highest inflation rates since 40 years. And on energy, I think it's up and up. I mean, I've been saying for a long time, energy is the only place I know that's defensive and offensive right now. And that's why, I mean, the pipelines that I've been endorsing for years have been doing phenomenally well. By the way, other than the last few years when they were very shaky, these pipelines historically returned about 17% a year, like clockwork, and then they had a lot of problems the last few years when they had trouble funding. But now that they pulled out, I think that's very realistic, if not higher. So they've been going up and up, MPLX, EPD, and USAC are the three I have. Most biggest is MPLX, but they're all together. That's most of the 31% I have in energy right now. And I'm not selling most of it. I mean, I trimmed it, but oil and gas are the place to be because one, there's this mentality that got spread, this narrative. Oh, we're going to get rid of the oil and gas in 3 weeks or a year or two. It's not going to happen. The projections for 30 years from now are to use more natural gas and oil. Yes, there's going to be some solar and wind and hydro, growing, but the world population, there are 3 billion people who don't even have energy right now. And as the world expands in terms of wealth and use, these people without energy want to cook. They want to maybe even drive and heat their houses. That's not impossible. And it's a growing world population. So it's not going to change. So oil and gas is, for so many reasons, why I've been saying the energy companies are not putting in what they used to because they don't want to, and they're also spending money on decarbonization, and they're not going to expand because if they're thinking, well, maybe we won't be in business 20 years or 30 years, we're going to return some money to the shareholders, which is their job. But the newest thing on energy, and I've already brought out over the different shows, maybe 15 points about it, but um, is the view of energy now is changing too with the Ukraine war. Because now all of a sudden, even though there was this hostility, especially from the Biden administration, towards energy. And I understand why they want to they're concerned about global warming. So, you could argue that either way. And I have mixed feelings about it, but I definitely think it could be a concern. I've looked at some charts where I say, wait a minute, this is a problem. But they're going about it all wrong because, first of all, this is amazing. But last year, 21, the U.S. put out 6% more fossil fuel pollution, 6% more carbon, and the world put out more. So how could that be when they're making all these efforts and solar's expanding? And how could this be? Well, if you look into it, it's because the whole approach is wrong of the Biden administration and a lot of liberals who are so hostile to energy. Because first of all, what do? They say we hate natural gas, so they try to close down natural gas, and which is really a great transition fuel and much better than coal and oil. So they close down natural gas. A lot, like certain states won't even allow the pipelines into their states. It's very hostile to that. And so what happens? They have to use more coal. They're burning more coal now. So that doesn't make sense. They close down the pipelines. So what happens? They have to truck in the energy. Like, let's say they truck in oil. Well, that just uses a lot of pollution and a lot of trucks on the road, which burn energy to get it there. And pipelines should be part of the solution. Then we say, okay, we're going to make it more efficient in the US. But then we push manufacturing out to China, which creates 1/3 of the world's fossil fuels. And nobody's saying, wait a minute, maybe we need to produce more and try to take business away from China because they're polluting the world. So the whole approach is wrong. But we're waking up, I think, now to the fact that at least a lot of people, some people won't admit it, but they're waking up to the fact that energy is important and the oil companies should be allies. They are spending money on decarbonization. There's new techniques being developed all the time to sequester it. And there's even pipeline they're working on to move carbon, so the pipeline companies may make money there too. So this is the other thing. Russia now is the big factor because we're probably not going to. Russia's going to probably be closed out for years. But there's an interesting article that why it's going to be very hard to solve the Ukraine war because this says that Putin's trying to take control of Ukraine's vast, extremely valuable energy assets and intends to integrate them into the supply chain. It says if he grabs this territory, he'll control all of Ukraine's offshore oil, its critical ports, and its critical energy processing and shipping infrastructure. So Ukraine is not going to want to give this up, and Putin wants it. So this war, as I said all along, World War II took. I said this one of the first days. I said World War II was expected to last a week or two. So who knows how long Russia is going to be? But at least now oil is starting in a lot of people's mind, being a strategic asset in natural gas. So if they use the right approach, they would encourage it. So, but that said, so I love still the pipelines. The three I mentioned especially, and I have a new one, new oil as my dividend pick. I'll mention later. But you need to own some energy because if energy goes as high as it could, I mean, it could go to 150 or $200 a barrel. It could stay up there, and I think it's going to stay over 100. It's going to affect everything else. So you need it as part of a balanced portfolio. So that's my first point. What do you think, Sasha?
Well, I agree with you on many points. However, I've noticed that there is now a real shift into green energy, primarily cars. Like even like Toronto Police is now making decision to go into electric vehicles, and so there will be many other industries. Probably there. I can see a lot of electric vehicles, fleets of rental cars,
Oh yeah.
and that will become more and more popular. As Russian war, I think it will be decided within next probably couple of weeks. Russians prepared a massive offensive in the Donbas region, and I think Ukrainians will kick their butt out of there. And then Russia will have nothing better to just to settle it. And but I want to tell you, is the most incredible damage to Russia is being done by the Western powers as the sanctions are concerned. I've noticed that they have a huge problem with the tourist industry, for example. Just
Oh
one
yeah.
thing, there is no fleet of
Oh,
airplanes
Russia's
to
going to
fly
suffer.
because they
Russia is
use
suffering, and
Boeings
it's
and
going to get worse.
Airbuses, and nobody's going to serve them. No spare parts available. So this is a massive. Somebody even called it the Putin-inflicted castration of Russia.
Yeah, no, it's going to be
It's,
probably
I don't know
miserable
how else
there.
to call that, but the castrated people that can't do that much, and in this case, one can only guess really what's happening. Another interesting development in the so-called green energy area is the companies that I've touched last week, and this is a company by the name Lilium NV. It's trading on Nasdaq under symbol LILM, Lilium,
Mhm.
and it's developer of the first all-electric vertical takeoff and landing jet.
Right. Yeah, they're like
And,
little planes.
yeah, and I just ran across the news release that it has submitted a full set of means of compliance proposals to the European Union Aviation Safety Agency, EASA, for the type of certification for the Lilium jet. Submission to EASA represents a milestone of the path to certifying Lilium's revolutionary eVTOL aircraft, the Lilium jet. So this is very significant development. Mind you, it may take some time to get all the certification process through and go get all the necessary approval. But seems to me one thing what speaks tons about this that if they went along with the process of certification, that means that their model is already in working order. It's flying. There are more tests will be done. So this process will take some time, and it's very
What percentage of your portfolio did you put into this? A small percentage, because it's speculative, right?
half percent, no more than that.
Right.
And
I'll have to look at that. I mean, it's an
yeah,
interesting thing. But by the way, I mean, first of all, electrical does not mean everybody thinks sometimes you think people think, oh, electrical, so we're not going to use power. But the electricity has to be generated by, most likely it will be natural gas, very likely, but it doesn't eliminate the need for fossil fuels at all. Plus, I think there's going to be huge problems with with uh, EVs being developed quick enough because I think there's going to be lithium shortages. I once read, I don't know if this is true, that if they powered all the cars in the world on lithium, and this was just a few years ago, they said that um, if they powered all of the cars on lithium the, in the world, that in 1 year they would use up all the lithium supply. So now that was just a few years ago. I don't know, maybe 4 years ago, but I'm just saying it's not endless, the lithium either, and also it's not going to be as popular, I think, as people think. I mean, some people will switch, but I'm not going to look. It's going to take a long time since I'm going to give up my SUV for lithium. I want a big car, one, but also I want to be able to drive a lot of miles, and it's new, and so I don't think people are going to jump on it as quick as they think. But it's a good thing. But it does maybe save some electricity. But in the end, you need natural gas to power it anyway.
well, look, there are so many electric vehicle cars companies.
Mhm.
I just will name just Tesla,
No
NIO,
Tesla, of course.
several. Now, to my knowledge, there is only one, this one particularly, Lilium, which is electric power jet,
Plane.
and this could use for commuting. I can see that a lot of it could be used probably as ambulance, maybe even police will use them, and it would transport people and
You mean the LLM, the LILM planes?
LILM. Yes, that's
Yeah,
a
yeah, yeah.
symbol.
I'm gonna have to look at that. You know what? I don't like speculation because I hate to lose, but once in a while it pays. As a matter of fact, Voxter, which we saw on the show now, is starting to pick up, and I held on to it, and now I'm in the green, and there's been some developments there. Now I'm a very small percentage. I'm a 0.1% in an IRA, no
Mm,
less. But
mm.
a little speculation is always interesting. Kramer is always saying, "Oh, put a certain percentage in speculation." But I personally would just rather make money and not lose any. So I'm cautious.
No, but if high yield dividend stocks are paying 7-8%
Oh yeah,
dividends,
that's what I'm saying.
and they appreciate in price just as well. So to put 0.5% on
No, no, it's
this.
not a big risk, really. You're right.
Yeah,
Now
and
here's
also remember, I said yesterday it was like around $5 or so, and I said that I will be buying more at $4 or under, and
Oh,
that's
so you're
exactly
looking for
where it
four
is now.
dollars or under.
It's now so 380
Oh,
maybe
okay.
something. Yeah, for I think under $4 it's
Well, maybe I'll buy a
probably
tenth of a percent or something too. Who knows?
yeah, yeah.
Now here's an interesting question, Sasha.
Mhm.
So it's both. So I've been thinking about the efficient markets and everything, and you had said you thought the market would go up, and you were right. I mean, and so I was thinking, first of all, with the inflation and everybody's worrying about the Fed, why is the market going up? With interest
Stocks
rates.
are going in a direction of the least resistance.
Well,
So
okay, to put it
I
that way.
think right now
And
we
by the
reach.
way, I had a lot of cash, so yesterday I put maybe almost 4% in an IRA, and I bought some treasuries at almost 3%, 20-year treasuries, because I
Mhm.
figured it may not go today. They're down already, the rates, and so I was thinking this is the question that's going to be interesting to me because I'm trying to figure it out. But the question is, they talk about efficient markets. You talk about it, everybody does it. When I went to MBA school, that was like most, thing that you probably heard ever, all the time. Market's efficient, it prices things, it absorbs information, but that's only, of course, when it knows, and there's a lot of uncertainty right now. So it's hard to say. So the market's going up and rates are going up and inflation's up. So you wonder why. Now, first of all, I think you might be right because if I look in the long run, and then I'll pose the question, but if I look at the long run, I've said all along by 2020, in the next few years, the rates will probably go to zero because Medicare is going to deficit in 2026 or sooner. It may be 23 or 24 because the new report's coming out and because of COVID. And that's a huge amount. It's more money of potentially the deficit than all stocks, bonds, and privately held real estate. So that's a huge debt. The government is not going to want to pay interest on that money when they have to print all that money to pay for Medicare Part A. Also, I was looking at the long run and two other factors. If mortgage rates go up a little more, obviously now it's already starting to have an impact on buyer mentality. But also, as the boomers age, they're going to start moving into retirement homes and unfortunately passing on. And that's going to start emptying out a lot of that homes, the second homes, a lot of the wealth is in their hands. And the millennials may not be like, oh, I need to buy a big house or, where I want a second house. Maybe they're just going to stay in the city and, want an apartment. So maybe they won't, and they don't have as much wealth. So maybe, and the boomers might spend a lot of their wealth as they're getting older, which is what I expect. Because I think that medical costs are going to absorb a lot of the boomers' savings. That's a separate thing, but I read this report this week that the annual healthcare spending by age at 60, at age 64 up to that bracket, it's only $8,000. From 65 to 84, it's 15,000. At age 85 plus, it's $34,000 because of long-term care, because of using up your deductibles, and that's not even counting the Part D Medicare premiums are going to go through the roof. So I'm getting to it. So these things are going to, in the long run, probably hold the economy down, hold growth down, and bring interest rates back down to zero. So here's the question: when the markets are efficient, what time frame are we talking about? Are we talking about the long run? So in the long run, the markets might be going up because they're right. The interest rate, this is just a short-term fluctuation in rates for the next few years. And if you're looking at the time frame of 20 years or 15 years or 30 years, maybe the market's perfectly right because if rates are going back down to 1 or 2 or 0 in the next 5 years or 10 years, then stocks are a great investment. What do you think?
Well, first of all, Medicare is not a new problem. It's been around now for a while, and
Oh
I
yeah.
don't think that for sure two of us on the show will not resolve that. So it's a kind of
No,
a
no, no, not just
our
all.
life. Yeah, it will be there, and you have to learn how to live with that. Now, if it's inflation scenario, then all stocks will have to go higher because they are assets which will depreciate simply because of the inflation issue. So if you take share of company like Microsoft uh, or or even Tesla, or even almost any other stock, they will appreciate even if they will just do the same business, the same profitability, the same assets, and so on. They will just simply go higher just because people, due to the inflation, they will have to pay more money for
Wait,
the
wait, wait.
same
I,
asset.
I have to ask you something that, but I mean,
Yep.
look, I agree with Microsoft. As a matter of fact, I also saw a study, very interesting, that when rates went up, tech went down, like the big tech, like Microsoft and
Mhm.
Google and Amazon, where I have some options or I own a little bit of Google, and they actually went down, but then they looped back up, and now
Mhm.
they went down, and now they're looping up again. It's a pattern, and I think because in the end, tech has probably got a lot of value because they can outgrow inflation. But
Absolutely.
when you're saying that, there's a lot of industries where they may not be able to pass it on. Let's say you're in the restaurant business. I'm just picking that, or airline business, or if let's say inflation kicks in. First of all, a lot of these companies, even the consumer companies, have 50% debt to assets. If inflation goes up a lot fast, then their interest rates or payments are going to go up, and they can't necessarily pass this on, especially if it's consumer discretionary. So it really depends on the sector. But my question is, what time frame are we talking about? In other words, when the markets are efficient, are they looking at efficient in because this changes your outlook. If you're saying, "Oh, I want to invest in stocks for 2 years, and I think they're going to go up," or "I'm investing for life," or 10 years. So, what do you think? What time frame are they looking? Long term or short term?
Well, as you know, my approach, I have two different portfolios. One, it's a longer time perspective, several years, hopefully. And we are talking about high yield paying dividend stocks, which are paying 6, 7, 8%, with exception of Pfizer. Pfizer is paying less than 3%. But in my opinion, Pfizer is a very special stock, a very special situation. But still, I hold it just as well as high yield dividend stocks.
Mm.
Now, the other stocks, my time horizon is 1 week, even
One
my
week.
1 week, absolutely.
Wow.
It's almost a day trading situation because you see, I told you many times that sometimes I raise cash up to 50% of my trading portfolio, not overall, but just
Right.
trading
Right.
portfolio, up to 50%. And I wouldn't mind even raising 100%, but because I have covered calls and I cannot sell the stock, so I hold those. But those positions that I don't have covered calls, I just
And,
sell them.
and I
Say,
have to
"Hey,
ask you a question.
yeah,
So on your trading portfolio, it's interesting because I've done well, but I do on my time frame is life, like basically for most of my investments. I don't want to sell anything. It's kind of like I want to buy a dividend stock with growth or a safe income stock. I just view them as streams of income. But for the trading portfolio, what return do you think you get on average, over the
I
years?
would say 20% with
No,
a
that's
covered
pretty good.
call, including, and of course, trading possibilities. I don't believe much in trading possibilities because you cannot outsmart the market makers, and all these people. But with covered call writing, you can do quite well. And but you see, covered call writing works only with the best of the best stocks. So
Right.
you are not afraid even if the stock will go down. Let's see, Nvidia took beating in the last few weeks, right?
Yeah, yeah.
I sold some puts. So most likely I still have time until May 20th, I believe. So I still have some time. But okay, I play scenario where I will be exercised and I will be I will own 500 shares of Nvidia. So that gives me all upside that sooner or later it will go higher. And also I can start selling covered calls, but far out of the money because I don't want to lose the
Right. You
stock.
don't want to use it.
Right? So
Yeah.
I will
So you're
sell.
getting an income stream from the selling of the covered
Right.
calls.
So the income is coming from selling calls, exactly. But this is entirely different animal from high paying dividends.
Oh, of
That's why
course. Yeah.
I keep them completely separate, and I treat them separately and differently, and different strategy. Absolutely. So it's almost like two absolutely. And these portfolios are not even connected in any way. I'm not using high yield dividend stocks to support my trading or so on. They're completely separate.
And when
So
you do the calls, what time frame? Like you do a week to
oh,
60
okay, that's
days,
a good question. Uh, the
typically.
best strategy is to say a month expiration, months and a half. I must admit that because of my greediness, sometimes I'm selling 3 4 months puts, for example, because premiums are so much higher, and I'm tempted to maximize my
Right. So it's 1 to 2 months, but sometimes 3 or 4.
yeah, on stocks as Nvidia, I'm so tempted with 3 or 4 months because the premiums are astronomical, and I just, I just can't fight my greediness in this situation.
You know what
Unfortunately,
the interesting thing about that, because I've sold a bunch of cover calls, and I have it on Microsoft now. I have some
mm.
on, I have one on Amazon. But the interesting thing is, it's kind of a strategy like chess, where, which you know so well, which you can just keep playing if you lose the first round. So, in other words, there's a second play and a third play. So, let's say you sell an Amazon call and or a Microsoft call, and it goes against you and it goes down. Well, first of all, if you didn't sell it at the very top, you could just sell that same call and make some small premium and just wait, because in the next 10 or 20 years you can wait forever almost and keep the money and just keep renewing Microsoft unless it really tanks.
But
um,
it's Peter, but it's a different strategy. You see, when you're selling,
no, I'm longer term. I'm doing leaps. I'm
okay,
doing leaps.
okay, but you're selling. So are you
But,
selling
but what's
covered?
similar? Wait. But what's similar is that you could do the same thing. So let's say you are selling a 3 month call on Nvidia and it goes down, but you could do it
No,
again, and
no,
you
no, no,
can.
no. Hold on. You're ahead of the game. First
What?
of all, I'm selling. I start my position with selling puts.
Oh, okay.
Now, I'm hopeful that maybe I will be exercised. If not, I just keep the premium selling next
Well,
puts
you could do the same thing. Exactly. You could sell the puts. You could repeat the process over and over, because
until
you're
you're
acting as
exercised.
a good way to
Okay,
sum
now,
it up is you're acting as the casino, basically. You're
in a
you're
way,
the one selling you're getting the spread, and sooner or later that's going to add up to more than the value of the stock over, a
but you see,
decade or
on a
two.
stock as Nvidia, I'm not selling the spread. I'm selling naked puts with the idea that
Mhm.
I'm not afraid to be exercised in case of the
Yeah.
stock will go down. For example, like just now, Nvidia, I'm facing most likely to be exercised. I sold 300 puts May 20th, I believe. So I could be exercised now with all the premiums what I've got for this transaction. And previously, my cost of Nvidia will be 335 a share, which
Right.
is of course less than where it's trading now. It's now 222, probably
And
221
if
today.
you get them, then you'll keep them and start selling calls. Is your second.
Yeah, then I keep the okay. So I now will own 500 shares of Nvidia. So I will start selling covered calls. So
Right.
again,
So you win either way, unless, over the long run, because you can keep selling calls on it forever, unless it keeps going down really fast, because you're always getting these premiums and it adds up over the years, to,
yeah,
collecting
so
all these.
in a way, in this type of trading, I think that both puts and calls, whatever you're selling, is really offset the at least paper loss that you are
Right,
incurring
exactly.
in the
But
market
in the
condition.
long run, it will, because in the long run, unless the stock goes to zero, you're going to get, all this income. And that's why it, is a good income stream. It's interesting. I have to probably do more of this, because everything's long term to me. I do an option for 2 years. I haven't done a lot of short term at all. I've always, wanted to like try to build up a trading portfolio in the short run. So maybe I have to start looking at like maybe.
Well, this is why I call our program modern investing.
Right, exactly.
I don't believe anymore in buy something and hold forever like
Well,
Warren Buffett.
dividend stocks. What
I
about
don't believe in that
you?
strategy.
Don't. I'm not selling MPLX, or at least not my plans, or SRRTF, or I'm looking at companies that are going to be there. I would think in 20 or 30 years, or they're going to return so much more in dividends that I don't, that
Exactly.
I'm just holding it.
Yeah, but
Warren Buffett did very well with that strategy, but you have to pick the right companies. It's a lot of work to find them. I
that's
spend,
right. But
sometimes you can't imagine, I could spend 20, 30 hours a week just looking for one company. And sometimes I can't find any. I scour Barron's, I scour everything just to find that one company that's going to have good cash flows, low debt, and is going to be there in 20 years with a high dividend. And I'll give you one this right now, since we're talking about that. So my dividend stock of the week now, I love the pipelines because I think they're defensive because they're like utilities and they're not priced that way. And they still have very high yields. They've been doing very well, but they're still looking at 7.5%, 8%, 9%, and USAC 11. I only have like 4% USAC. I should have held even more. I sold some at a big profit, but I'm not as confident. But MPLX, I think, is still undervalued and is going up and up. And EPD is safe. But so but I wanted always something as a hedge against the rest of my portfolio because these are pipelines. But if oil just keeps crushing the market, eventually it's going to affect a lot of stocks. Consumer discretionary, who knows where it's going? 100, maybe it'll go to 150 and stay there for a long time or higher. And so as a hedge, I had Devon, but first they're talking about like an oil company profit tax, and I don't think Democrats will get through, and it'd be a big mistake because it's just going to crush production even more. But they're talking about it, so it made me nervous. But then I sold that 1%. I moved into a company called Blackstone Minerals, and it's a very interesting company. It's got a 7.1% dividend. It's about 75% gas. They had a lot of hedges going into this year and into 22, which was even reducing their cash flow, but they were already covering their dividend. But these hedges are coming off now. And these hedges that they had were at much lower rates, like roughly half of natural gas. I don't know oil, but much lower. So now as these hedges come off, they won't be losing money on the hedges, and they'll much more be able to cover their dividend. And two different articles said they might increase it by almost 100% or 80%, 70%, somewhere around there. And I can see the arguments for that. They also paid down their debt to almost zero during this period. So and the other interesting thing is they have huge amount of natural gas and oil interests. Some of them are royalties, some they own. But if you look at a map on the BSM website, Blackstone Minerals, and you go to investor relations and look at their presentation, they have a map and it shows huge amounts of the United States that they have an interest in. I mean, there's blue all over the place. And you go, they own a lot of minerals. So if they can extract a nice cash flow for maybe the next 30 years, and there's a good chance oil and gas aren't even going to be in, natural gas will probably be higher in use in 30 years, 20 years. So it's a good hedge against everything else because I'm getting 7%, anyway. And I put this in an IRA because it's a small interest. I didn't want to pay the K1s. But, and if you own too much in an IRA, then there's a UBTI tax. You have to look that up. But as a hedge, because look, I own so much other stock in my IRA, particularly, that I'm saying if oil goes up too high, it's going to affect a lot of things. So this will sort of balance things out. So
I looked at this. It's a pretty good company. I agree with you. And
Blackstone Minerals?
yeah, I've looked at it, and also high dividends and very secure. So this is obviously an option to.
Yeah, I think it's a good way to get into energy.
Yeah.
Again, I like pipelines because the pipelines are going to keep running as long as I need gas for my home or oil for my car. And if you're getting an 8-10% return, whatever, 6-7 and growing, and easily they're covering their cash flow. These companies, a lot of them are buying back the shares. Then you go, well, I'm going to get my money back anyway with the MPO, with the limited partnership tax advantages, or in an IRA, you don't pay tax if it's not too much. And so it's a good bet, and that's why that's the biggest, investments I have along with some tech.
Yes, Peter, thank you so much for today's program. The beauty of the stock market is that it's existing today, tomorrow, next week, and next year. So there are so many opportunities, solid one like BSM and paying dividends. And I like Lilium company because I'm fascinated with the idea of flying, sort of a combination between car and a plane.
Yeah.
It's more a plane. I'm really fascinated with that. I'm willing and I'm looking for similar companies that has the same concept and development. So far, I haven't come across one, but
Well, they may be the market leader then. That could
so
be worth
maybe
a
they're
lot.
market leader. So it's a speculation at this point, but at this
Right.
price, maybe it's a good entry point. And of course, high yield paying dividend stocks that
Oh, of
will
course.
cover all your trading and speculative stocks and everything else. And of course, preservation of capital. This
Oh,
is
yeah.
number one concern.
Especially these days.
Yeah. So have a good week, everybody, and we'll see you all next Wednesday. Thanks a
All
lot.
right.
Modern investing. Bye bye, everybody.
Bye bye.